Remember, tax laws are always changing, estate tax laws are always changing, and gift tax laws are always changing. And we want to be taking a look at what's going to be working for you for 2022. Welcome. We have a lot to get to when it comes to estate taxes and gift taxes. What is staying the same and what is changing for 2022. You know, there's always changes that happen with taxes, and that's probably something that's on your mind right now as you're paying your taxes, as you're finalizing things from last year. You want to be taking a look at this year as well and finding the ways that you can be saving taxes, not only today for income taxes, but also in the future as part of taxes for your estate and gift taxes. So let's dive in. My name is Nathan Crampy. I'm the founder of Lions Wealth Management. I am a certified financial planner and a certified private wealth advisor. So I deal a lot with estates and all the details surrounding gift tax. Well, let's go through 5 items that are going to be very beneficial for you to know and understand as part of the process that you have in place for trying to minimize taxes with your own wealth. First thing that I want you to be aware of this year is that, well, the exclusion for the estate taxes has increased. Now, generally speaking, that does happen most years, and this year is no exception. It has increased. So now we're up to $12.06 million that you can be passing on to your heirs. That is without tax as part of the exclusion. So you have $12.06 million, and your spouse, if you are married, has $12.06 million combined with what's called portability. You have $24.12 million that you can be passing on to your heirs without being subject to tax. That's part of the exemptions. Wow, that is an incredible amount, and most likely that's going to be covering pretty much all of your estate or most of your estate that you have. Now, the things to know is that the second item on our list here is that things are changing, obviously, with taxes in a couple years. So what we are looking at is a sunsetting of the Tax Cut and Jobs Act that President Trump put into place, and that happens in 2025. Now, what that means for you is that we are going to actually be lowering and bringing back down the estate taxes. So that may go as low as $4 million or $5 million per individual. So maybe up to $10 million for a married couple as part of portability. Now, just kind of side note here as well, as we're talking about this, check your state as well, because there are many states that do not allow portability. So they may have the same level of estate exemptions as what the federal level does, and there's a number of states that don't. So if you live in a state that does not offer portability, your plans are going to change. If you are in a state that maybe the estate tax laws in your state are lower, then obviously your plans will change from this as well. So there are many states where it may only be $3 million or $5 million instead of the $12 million for your estate exemptions. That is something very important. But what I also want you to know is that as part of what we are talking about, the Tax Cut and Jobs Act sunsetting, there will be a reduction of the estate tax if nothing happens come 2025. So that means that instead of 12 million, we may be dropping back down to 5, like I said. Well, that can be a huge opportunity to do some correct planning today. But I want you to realize this, and this is again our second item, is that there's what's called clawback provisions. So generally speaking, that if you passed away and left that 12 million, then the laws reverted back, what a clawback provision says is that you can owe tax on that amount because of the changes of the tax laws. Well, what is new is that those clawback provisions have disappeared, and what is the 12.06 million is permanent now. If something happened to you, you passed away, passed on that money as part of your estate, you will not be subject to excess and extra taxes when the laws revert back to where they were. Something incredibly good to know as part of your planning. Alright, so we've had an increase, our first point, of estate taxes. The second aspect is that the clawback provisions have been eliminated, so that's not going to happen. The third aspect then that I want you to be aware of to plan correctly comes to the step up in basis. Now, last year in 2021, we had some bills come forth that were going to be voted on in Congress to basically eliminate the step-up provisions. So what that would mean is that if you passed on assets to your heirs, instead of having a cost basis that was lower than what the asset price was, and that cost base coming up to where the basically date of death occurred, when you pass on those assets to your heirs, the law was going to be written that they would keep that original cost base. So now they would be subject to the tax, and your estate would be still subject to the estate tax based upon that asset. So it could have been a double taxation that they were considering. I want to let you know that did not pass, that was not voted upon, and so the step up in basis that is a big part of probably what you are looking to do with your estate is still in place. There are no changes as part of the step up in basis. That was point number 3. Point number 4 that we want to be really utilizing on a yearly basis are the gift tax exclusions that you and your spouse have. Now, that has increased as well. We have $16,000 this year that you can be passing on to an individual. So this again can be, say, maybe one of your heirs, your children. Well, we also have $16,000 that your spouse can be passing. So we can be passing this year now $32,000 to one individual without having to file a gift tax return. And that does not come back against your gift tax exclusions. So what we are seeing here is, let's say we have 2 children. We can be passing on $32,000 to one, $32,000 to another. That is $64,000 this year that you can be passing on without having to file a gift tax return. Now that may not be enough, but that definitely is better than nothing for having to be able to pass on some assets and doing so in a way that is not subjecting yourself to any tax. Okay, so we've covered a lot already. We've covered estate taxes, that the exemptions have gone up. We've covered the fact that the clawback provisions are being eliminated as part of these stepped up estate taxes. We've covered the fact that step up in basis for your assets are still available for you. And we've talked about the gift taxes, that we have an increase in the exemption before you even have to file a gift tax return. The last and final thing, our 5th point that I want to be talking about, comes back to, well, the gift taxes again. But it's the difference between paying for something as part of a gift tax and paying for something as part of an estate tax. You see, when we talk about gift taxes and estate taxes, right now they have the same exact exemption, that 12.06 million. So many individuals think that no matter if we pass on as part of the estate or pass on as part of gifting, they're the same. And that is not true. You see, one is tax inclusive and one is tax exclusive. Let me tell you what I mean by this. Let's take an example here, and let's talk about gift taxes first. Let's say you want to be gifting $100,000 to maybe say your son. You've already used up your exemption, that's $16,000. So now this whole $100,000 will be subject to tax. So that we are going to have the $100,000 is going to be gifted. Now the tax that's owed, and let's just keep numbers really simple here. So this is obviously going to just be an example, simple numbers so that you can understand the concepts, which obviously are different than the actual tax numbers here. But let's say we have a 50% tax on the gift. So we take the $100,000, so that goes to, say, your son. Now we have to pay tax. So of that $100,000, we pay an additional $50,000 to gift that money as part of a 50% tax for the gift tax. That is what is called tax exclusive. So we are paying tax on that $100,000, and that is it. That is different than estate taxes. You see, estate taxes are different. They're tax inclusive. So let's say the same thing happens here. We have $100,000 that we are passing on as part of the estate, and we have a 50% estate tax. Well, let's go back through the math. If we take out $100,000, you wouldn't be passing on $100,000. We'd be passing on less than that just because of the estate tax being inclusive. So now we have to take out more money to equal that $100,000. Well, what is it? It's not $150,000 because half of that's only $75,000. So now we have to take out $200,000, pay tax on 50% of it. So $100,000 is going to go to the government as part of tax. $100,000 is going to go to your son or your heirs, whatever it is. That would be now part of the estate that is going to be the final version that you would be giving to them. So what this means is that there are going to be good opportunities to pass on money by gifting the assets, and there are correct assets to gift as well that will not be subject to possibly even a lot of tax to your heirs. If we can do that correctly as part of the planning, that will save you, in this case, an exorbitant amount of tax between being tax exclusive and tax inclusive. Okay, 5 ways, 5 changes for estate and gift taxes, and 5 things that have maybe stayed the same as well, depending on your planning. With that, there has been a lot of kind of changes that occur with the estate on a yearly basis, and updating your plan every year is going to make sure you keep up with that. So I want to thank you for watching this. Please click on this video to learn more about taxes, wealth planning process, and what that means to you and your wealth. So with that, take care, enjoy the day, and I will be looking forward to talking to you soon.